Hey, hi, good evening, ladies and gentlemen. My name is Vishal Tibrewala, and I am the moderator for today's session. A very warm welcome to all our distinguished guests, respected members of ICAI, esteemed speakers, and participants joining us from India and across the globe. On behalf of ICAI Singapore Chapter, it is my great pleasure to welcome you to this global webinar on FCNR deposits for NRI, organized in collaboration with International Affairs Committee of ICAI and ICAI Dubai Chapter. While we regularly organize webinar with different chapters and committees, but today's session is truly special. In this webinar, we have participations from more than 25 overseas chapters, representing professionals from North America, London, GCC, which includes Dubai, Kuwait, Qatar, a lot of other regions, Africa, Asia Pacific, and obviously Singapore. Your presence reflects the strength of the global ICA fraternity and our shared commitment to continuously learn the professional excellence. I would say in the past few weeks, for all NRIs worldwide, one question remains: how can I invest in the latest FCNR scheme from RBI India while managing the risk and earning attractive returns? So today's webinar has been carefully designed to answer that precisely. In today's session, we have expert speakers. So if you see, our speakers are from HSBC, which is a global leading bank. We have for Ajit Pandit, who is from HDFC, which is the largest private sector bank, and none other than Mr. Nilay Singh, who is from largest public sector bank, SBI. So today's session would target about what basic FCNR deposits are, what are the key benefits and regulatory framework around it, tax implications, currency protections, investment opportunity, and more importantly, practical uses cases, and how we can effectively leverage this product to increase the returns. Before we begin, I would like to put a small disclaimer that today's webinar is intended purely for education and information sharing session. It is not be regarded as an investment advice or a solicitation or recommendation to any financial products. All participants should do their own due diligence and seek independent professional advice before making any investment or financial decisions. To start with, I would give a brief introduction about myself. So I am part of the management committee of ICAI Singapore Chapter. I have over 20 years of experience in institutional banking and corporate banking, specializing in relationship management, credit risk, and cross-border financing. At present, I work with DBS Bank based in Singapore as Senior Vice President, India Desk. In my current profile, I work closely with Indian corporates to support their international banking needs and global growth strategies. Uh, Ironically, this is my 18th year with DBS Bank, so I will be becoming an adult with DBS. Previously, I've worked with DBS India, Yes Bank, Kotak, and ICICI. In addition to CA professional degree, I have completed company secretaryship, and I've also completed 3 levels of CFA program. It is my pleasure to host you for this full session. So this basically gives a kind of an event flow of today's webinar. We will have motto song, and which will be started with address from our Singapore chapter chairperson, Mr. Sanjay Gatani, followed by address from Rishi Chawla, who is our chairperson from ICAI Dubai. Then we have 3 distinguished speakers, Mr. Ajit Pandit, Mr. Nikhil Singhal, and Dr. Nilay Ranjan Singh. The technical sessions will be followed by a Q&A, and then vote of thanks would be provided by Nikhil Jan, our secretary from ICAI Singapore Chapter. I would now like to request everyone to stand for the ICAI motto song.
Yashasvapteshu jagrati. Yashasvapteshu jagrati. Kamam, kamam, kamam. Nirvimala, nirvimala. Adeka shukram, adeka shukradamam. अस्मिन् लोकः अस्मिन् लोकशः सर्वे तदुक्ता सर्वे कश्चन यदि कश्चन एतद्वैता 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 एतद्वैता.
Thank you, everyone. I would now welcome Mr. Sanjay Gatani to give the opening remarks for the evening.
Thank you so much. Thank you so much, Vishal. I guess I'm audible. First of all, respected President of ICAI, CA Prasanna Kumar D, in absentia, Honorable Vice President, CA Mangesh Kinnareji, in absentia, distinguished banking leaders, speakers, chairpersons of all overseas chapters, and my dear professional colleagues across the globe. A very warm greeting from Singapore. It is my privilege to welcome you all to this first global webinar involving more than 25 chapters on the most sought after topic right now, FCNR deposits, a topic that has assumed immense significance for the India, for the banking sector, and the global Indian diaspora. The last time, if I may mention here, the FCNR was introduced by India was in 2013. And if my figures are correct, that initiative mobilized approximately $34 billion from the NRI Indians, playing a pivotal role in strengthening India's foreign exchange reserves and restoring confidence in the Indian economy. Today, here we are, 13 years later, we have again turned into India's greatest global strength, its overseas Indians. Now, this time, it's a strategic initiative to reinforce the resilience of one of the world's fastest growing major economies, strengthen foreign exchange reserves, and support India's long-term economic aspirations. The current program, if I may say so, is expected by market participants to mobilize between $60 to $70 billion, with early inflows till date approaching US $10 billion within weeks of the scheme's launch. This demonstrates one remarkable fact: the confidence that the global Indian community continues to repose in India's growth story. India today stands at the threshold of becoming a 10 trillion economy over the coming decade. As we move towards the vision of Viksit Bharat 2047, the role of NRIs extends far beyond remittances. They are investors, entrepreneurs, innovators, and trusted partners in India's development journey. As chartered accountants, we occupy a unique position of trust. So today's webinar, therefore, is both timely and relevant. We are privileged to have an exceptional panel of banking leaders from the India's largest public sector bank, banking leaders from the India's largest private sector bank, and one of the leading international banks, HSBC. So they are also subject matter experts who will share their practical insights on latest RBI measures, operational aspects, tax implications, and opportunities that the initiative presents for NRIs and financial institutions. Before I conclude my opening remark, I would like to sincerely thank our President, CA Prasanna Kumar DG, whose vision of strengthening ICAI's global engagement continues to inspire initiatives such as this. My heartfelt appreciation also goes to our Vice President, Mangesh Kinnareji, the International Affairs Committee, and each and every overseas chapter, including the Dubai chapter, which has come together today to make this global knowledge sharing platform possible. So on behalf of the ICAI Singapore Chapter, I extend my sincere gratitude to all our distinguished speakers and participants for joining us today. I wish you all a highly insightful, engaging, and enriching session. Thank you. Jai ICAI, Jai Hind. Over to you, Vishal.
Okay. Thanks, Sanjay. And now we would invite Rishi Chawla, who is our chairperson from ICAI Dubai chapter and co-host for this webinar. Over to you, Rishi.
Yeah, hello everyone. Hi Vishal. Thank you for the warm welcome and always great to be on a platform like this and with our brothers and sisters all the globe. And when we do joint events like this, it shows that we are one big large family and always feel so special to be here with everyone here. So with that, good afternoon, everyone. I met our President Sir Prasanna Kumar D and Mangesh Kinare ji yesterday. I am in India right now. Just came to say hello to them and take their blessings for all the initiatives which they are doing. And I'm continue to learn from them. And I also met our secretary, ICI Batraji yesterday. I had the opportunity to meet also our secretary, ICAI International Affairs, Mudi ji yesterday. And it was such a great pleasure. It felt like I relived my CA days. I went to ICI Bhavan in Delhi. It was such a great time there. And also like to give greetings to our chairperson, Singapore Chapter, CA Sanjay Gatani ji, for doing so much of efforts in bringing this webinar. It's not easy to communicate and coordinate with so many chapters and so many people around, but you have done a great job, and always pleasure to be part of this initiative along with you, and also to the Manji Committee of Singapore for doing a great work. And also speakers of the day, Nikhil ji, Ajit ji, and Dr. Nilay ji, thank you very much for taking your valuable time out for all of us and sharing this great information with all our ICI fraternity. It is truly a pleasure to welcome all of you to this important session. What makes today's program even more special is that professionals and NRIs from more than 25 chapters have come together, reflecting the strength of our global Indian community and our shared commitment to staying informed and connected. The launch of the FCNR Deposits Initiative is a very timely and significant step. It not only provides an attractive opportunity for NRIs to participate in India's growth story, but also strengthens the country's foreign currency reserves while offering confidence and value to the investors. It is an initiatives like these that deepens the financial partnership between India and its global diaspora. I'd like to express my sincere gratitude to our President, Sir C.A. Prasanna Kumar D., Vice President, Sir C.A. Mangesh Kinare ji, and Secretary International Affairs Mudi ji, and our Secretary Batra ji for their constant encouragement and support in bringing meaningful initiatives like this to our members across the world. Your leadership, sir, always continue to inspire us. Thank you very much for helping us in organizing this event. I also like to encourage everyone to make the most of this unique gathering, not only to gain insight from today's discussion, but also to connect, exchange ideas, and build relationships with fellow professionals joining us from across the globe. Take this session where you can ask a lot of questions from our speakers here, write it in the question windows, and make best use of this gathering which we are having today. So with that, I hand over back to Vishal to take up the proceedings. Thank you very much.
Hello, friends. Good evening. Thank you, ICAI Chapter Singapore, for giving this opportunity. Thank you, Prasanna ji, Rishi ji, and Sanjay ji. This is a good initiative where we are able to connect our NRIs, person of Indian origins. First of all, let me thank you, all NRIs PIOs, who has given a greater contribution to the motherland India. Country cannot forget their contribution, which whenever country has called. In 1992, India Development Board. In 1998, Resurgent India Bond. In 2001, India Million Bond. And in 2013, Swap Window 2013. Whenever country has called you, you have always stand with the country and you have remitted money in India to strengthen the Indian economy. As a token of appreciation, country every year celebrates 9 January as a Pravasi Bharatiya Divas. We are proud of what your world leadership across the globe. Thank you for giving the recognition India on the global platform. With this session, FCNR deposit, we will have the more insightful information. We will understand what is the basic of FCNR deposit. So let us start. What is the FCNR deposit? So FCNR deposit
Sorry,
is a
Ajit.
fixed. Yeah. Vishal?
So would you like to share the screen or should I me to
Yeah, please, you presentation, please. Can you, Vishal, start the
Okay,
presentation?
1 second.
Yeah. So let us understand what is the FCNR. FCNR accounts is a foreign currency non-resident account which is maintained in fixed deposit in convertible foreign currency by the non-resident individual or PI or OCI with the Indian authorized dealer, that is authorized bank. The deposit and interest maintained and paid in foreign currency. This is for protecting your fluctuation of any risk, currency risk. Therefore, these are the safest deposits, term deposit for NRIs, PIOs. As far as the FCNR account concerned, it is governed by country's central bank, reserve bank's master direction, and its interest rate regulation. Who will benefit with this? This can be benefited only to NRI, PIO, and OCIs who resides outside India. They enjoy tax-free interest in India with repatriation benefit outside India. Let us go and understand the FCNR deposit, why it matters for our NRIs, PIO, and OCIs. Simple. The purpose and benefit is simple. This FCNR deposit scheme, wherein you put your money, it does not have currency risk or depreciation, and it offers tax-free interest income in India. In this account, funds remains in US dollar, in foreign currency, whichever you choose, GBP, Euro, Australian dollar, whichever currency you choose, and it will not have any impact at rupee fluctuation and conversion. You will get confirmed returns on this fixed deposit. Whatever the rate of interest is offered at the time of booking deposit, it will be paid to you. This, since Reserve Bank of India has prescribed certain guidelines, which we basically have to follow all authorized dealer with the repatriation. It is one of the best investment tool in your portfolio with the repatriation benefit, which you must use. Now understand who can invest in FCNR deposit. After this scheme, we started getting bank. Many foreign national, foreign corporates, they have started showing interest on booking the FCNR deposit. But my dear friends, this scheme is only for NRI, non-resident Indian, who is holding Indian passport, residing outside India, working outside India on valid work visa or resident visa. Similarly, this facility is available for a person of Indian origin or overseas citizen Indian who are staying outside India. Any non-resident Indian who are working for foreign shipping company, they are also eligible to take this benefit of FCNR deposit. Who are not eligible, a resident Indian who is living in India or is visiting outside India for a tourist visit, he cannot be a NRI, he cannot be treated. Non-individual entity registered outside India, they cannot participate in this deposit. For this scheme is not for them. What are the documents required for as a KYC for opening FCNR account in India with any bank? Your passport copy, your valid visa, your OCI card, your overseas address proof or PAN. This is the basic KYC document required for opening account with any bank in India. Now let's see who can be a joint holder in this account. Yes, the joint holding facility is also available in this account. This account can be held in the single name, the jointly held with the NRI or person of Indian origin with any mode of operation. In case NRI is a single holder residing outside India, his close relative is in India, he want to add them as a joint holder, yes, the facility is available, but the mode of operation will be the former or survivor, and NRI PIO will be the always first holder. Nomination, very, very important. In India, the nomination facility is a customer friendly and very, very convenient for customer. They have to just fill one form DA1 and mention who can be the nominee. The nominee can be NRI, nominee can be a resident individual, nominee can also be a minor. When NRI comes back to India, what happens to this FCNR deposit? This deposit can continue till maturity. On maturity, you can renew. If you don't want to convert money into Indian rupee, you have option to renew this deposit as resident foreign currency deposit, or you can convert into Indian rupee and credit to rupee account at the conversion rate at that time available. Now let us compare the FCNR deposits with other type of accounts. So most of the NRIs, PIF and OCIs, they can hold all NRIs. These three types of account. Which are the three types of account? FCNR, NRE rupee, NRO rupee. So as said, foreign currency non-resident deposit is FCNR deposit. It's a term deposit. There is no savings account facility in foreign currency in India. NRE account, there are two types of account. NRE rupee savings, NRE term deposit. Similarly in NRO account, NRO rupee savings account and NRO fixed deposit, term deposit. Currency risk, in FCNR, there is no currency risk. Money remains in the foreign currency on maturity, along with the interest in that respective foreign currency, you get the money in foreign currency only. NRE, yes, NRE rupee account, money comes from abroad. We convert into Indian rupee at the today's exchange rate. Okay, and we credit to NRE rupee savings. Customer can spend money in India for local expenses. He can make the investment in India. What are the eligible as per FEMA? You can book the fixed deposit, NRE fixed deposit, that's fixed deposit, and enjoy the interest. It's a tax-free. NRO is a rupee account wherein you can remit the money abroad, and there is an exchange risk of conversion. Taxability, most important point for NRIs. To attract investment from NRIs from abroad, government has given the tax-free interest on FCNR and NRE deposits. It's important. Rupee also, NRE rupee deposit and FCNR, it's a totally tax-free in India. NRO account, whatever interest you earn is a taxable in India at the rate of 30%. However, under DTAA, you can take the lower deduction of tax by submitting tax resident certificate and Form 10D. So required document you have to submit starting of the financial year, and then you can avail that lower deduction. As far as important point is repatriation or remittance outside India. Funds held in FCNR accounts are fully and freely repatriable, no restrictions. If you remitted $100 million in India, along with interest, you can take out entire money outside India whenever you want. NRE rupee also, same thing. It's a freely repatriable. You can convert into the whichever foreign currency you want to repatriate, no restriction. NRO account, yes, repatriation is there, but there are limitations. What are that? Up to $1 million, you can repatriate every financial year after payment of taxes, or you can credit back to your NRE rupee account. Apart from that, you have the dividend earned in India, interest, rent, pension. This is normally termed as a current income. That is also eligible to repatriate outside India without any limit or credit to your NRE rupee account. So this is who it's a best for your foreign savings, foreign earnings, FCNR and NRE accounts are the preferable account. NRO account normally, whatever during your NRI resident tenure, you have some legitimate dues. That purpose you can credit your NRO account. So this is a NRO rupee account. It's for your legitimate dues earned in India. So let us go for the FCNR. Let us see what are the now after FCNR NRE simple comparison. Let's go to the other chapter. What are the eligible currencies and tenor of deposit? FCNR deposit can be held in any freely convertible currency in India. Each and every authorized dealer offers various currencies. You need to check with the authorized dealer at which currency they are offering these deposits. Generally, US dollar, sterling pound, euro, Australian dollar, Canadian dollar, Japanese yen, and Singapore dollar, Swiss franc, other than these currencies, AED, are offered by the various banks in India. Deposit tenor and repayment. This deposit, as said, the principal amount remains in foreign currency. Interest amount also you earn in foreign currency and repaid, remitted in the respective foreign currency. On maturity, you have a choice either to remit money back to outside India or convert into the Indian rupee and credit to savings account. What is the minimum tenor to book this deposit? It's a 1 year and maximum tenor is 5 years. This is as per Reserve Bank of India guideline. Now, what are the FCNR benefits and growth? Let's say FCNR deposit protect customer, from currency depreciation by holding deposit in foreign currencies, throughout the term. So you need in between, bank will not convert to Indian rupee, money will remain in the foreign currency. You earn the tax-free interest in India. These are the basically compounding yield will be very high in this. You earn your returns will be the good returns in foreign currency terms. As I said, it's a fully repatriable principal plus interest, and so fully repatriable flexibility is there. Now, as per the highest interest rate concern, Reserve Bank of India has come up with the RBI swap window. So in that, RBI said to all banks, you offer 3 to 5 year of FCNR deposit. Under that, bank can offer the higher rate of interest. So it's an opportunity for our NRI friends, PIOs, to invest your money for 5 years and enjoy this swap window with the higher yield. And this money is going to be a fully repatriable. Please block your money for 5 years. In the world, none of the country is offering such a highest returns. In India, normally in US dollar, more than 6% interest is being getting offered by the all banks. Now, compounding and growth. Let's talk about the compounding and growth. How compounding and growth works. RBI is saying the interest earned on FCNR deposit can be compounded considering 360 days. That is a half yearly compounded it will get. So let's say if anyone has kept a deposit for 1 year, compounding will be the 180 days first, then 180 days, and then remaining 5 days or 6 days. While in NRE rupee deposit, it's a quarterly compounded. So here I would appeal during RBI swap window, you will get very, very competitive rate of interest and you can achieve your financial goals, education, for what are the planning you have made. education, retirement, maximum growth through your compounding benefit. This is a stable funds. Your money will remain stable. There will not be any currency risk. So let's say let us discuss about currency protection and repatriation and liquidity. Currency protection, let's say if the conversion rates come from the 83 to 90 per US example I'm giving. Though here that rupee will have the hit, but not the FCNR. It remains in dollar. It will continue in the same dollar. Your principal is protected, interest is protected, and you are while taking the money out, you will be getting your principal and US dollar amount in foreign currency. For premature withdrawal, allow in the normal FCNR deposit. Before 1 year, if you break, you don't get any interest, but you can take your principal back. So, however, in this FCNR swap deposit scheme, RBI has put up one condition. RBI said premature withdrawal, 1 year lock-in will be there. Okay, before 1 year, you cannot break the deposit. Your money has to be there. Even if you book for 5 years, you have option to break only after 1 year during the swap window. What is the facility? What is the option? In case of in India, you need loan in Indian rupee, again FCNR deposit. In INR, you can take loan, or you want loan in foreign currency, you can take outside India through your foreign branches, the loan in foreign currency. So Vishal, we'll go with the conclusions after this. So what is the key, Vishal, next? Key takeaway with this total session. So benefit of FCNR deposit I have explained. There is no currency volatility. It's a tax-free interest, fully repatriable principal, multiple currency options are available. You can build your portfolio and keep FCNR deposit as one of the excellent investment in your portfolio. You will get the support guidance from all banks in India for helping for documentation, opening an account. This scheme we have started on June 2026. This will get closed on 30th September 2026. So accordingly, you must plan and invest in India. In 2013, country mobilized more than 30 billion. This time we are expecting more than 60 billion to come to India, and definitely India will have the good forex reserve. Thank you, Vishal, for giving me opportunity. Over to you, Vishal.
Move to our next speaker section, Nikhil Singhal from HSBC. Before that, I would request Sanjana also to take care to take over the screen. Okay, I think she's done. Okay. Thanks, Sanjana. So Nikhil, as you can see, he's from HSBC. He's heading the international business corridors for HSBC India. He is an alumni of IIM Ahmedabad with over 20 years of experience in private banking across global financial institutions. He has extensive experience in managing ultra-high net worth individual clients and family offices across international market. At present, he heads the international business and corridors at HSBC, driving cross-border banking solutions for global Indians across key industrial corridors. Previously, he led the private banking business at HSBC India and also have worked across in Standard Chartered Bank, Citibank London, managing private offshore clients. He's passionate with capital markets, emerging investment trends, golf, and fitness. Over to you, Nikhil.
Thank you so much, Vishalji, and my heartiest congratulations to the ICAI chapters to actually put this together. It couldn't have been any more timely, but to be able to pull through with 25 plus markets to be able to coordinate this across time zones, I really want to compliment all of you. Sanjay ji, ICAI Singapore Chairperson, and Rishi ji, ICAI Dubai Chairperson. Thank you, first of all, for inviting me over as well. We've been fortunate that in various markets, we've actually worked with ICAI chapters, plus also recently we were part of the big event that happened in India as well, where the WOFA forum happened. So we are extremely delighted to be part of the ICAI events. I think these last 3-4 weeks have been full of action. And the result of what you're experiencing is in terms of the whole euphoria is a function of what has transpired in the last, I would say, about a year and a half or so. And which is where I want to just, and of course, Mr. Ajit spoke so well about the nuances of the FCNR and how the repatriability, etc. works. Very, very relevant in terms of who it's applicable to. I just want to take a little bit of a step back to see how the context has actually built over the last, let's say, a couple of years or so. And part of it started with the whole tariff story that played out through most of 2025. Initially, it looked benign and everybody thought it would sort itself out in maybe a couple of months. And then we saw the tariff hangover actually extend beyond the normal when the tariffs actually got extended to almost 50%. And at a point in time, we became amongst the most tariffed countries. What that led to was, of course, your impact on export competitiveness was directly impacted. But it also meant that within the basket of emerging markets, India, which was amongst the heavyweight markets and attracting bulk of the global emerging market funds allocations, we were close to about 15 to 16% at that time. So we were almost overweight in most portfolios. We suddenly felt the heat, because when you go from an overweight position to suddenly a big negative event unfolding, the pressure of outflows can be humongous. And that's largely because a lot of these flows are ETF outflows, which can be rather hot and can move out at a very short notice. So most of 2025, actually, because of these massive headwinds, we saw outflows. A lot of it was FPI, though we continued to attract FDI monies. And within the FPI bucket, you saw a bulk of it actually heavily loaded towards ETF money. We felt when the trade deals were almost done, you had the FTA with Europe and the UK, etc. Europe, of course, has a timeline for 1 year. There was fair amount of optimism. Of course, the US deal happened. And then, lo and behold, we were staring at another crisis, which started off somewhere in February and March this year, and which kind of actually continues till date, which is the Iran war. Now, that has actually, the funny part is in none of these we were directly the party which was influencing any decisions, but the impact has been disproportionately large. In the case of Iran war, of course, we're not even as a party to it, but because we're one of the fastest growing large economies with very high allocation into India traditionally. We are also the most vulnerable right now because of the 80% import basket dependency, and which is where this was clearly felt in the way the rupee movement happened. So if you look at the left-hand side, I've just given a brief context of how the exchange reserves have moved over the last year and a half or so, and you've seen that from a high of about $760 billion. Obviously, we've felt the pressure on the reserves. The cash flow and the reserves have obviously depleted, and so we are currently around 660, 670. It is still, by the way, amongst the highest in the world. So not from a worry perspective, but just that the flows have been impacted that way. The resultant of this also has been because most of the emerging market currencies have also corrected sharply. We have seen a very sharp fall in rupee from 86 to about 96 now. While we were, while other markets have also depleted in their currencies, the relative fall for India has been larger simply because of the dependency on the import basket of crude. So clearly, we are facing headwinds. I mean, in the sense that macro headwinds, which aren't really a function of the actions that India is taking. In all of this, you have to obviously realize that the market continues to be resilient. And I'll take a cue from what Sanjay ji was also saying earlier, where the monies from the domestic investors have flooded the capital markets in India, as also the monies from overseas Indians, OCI holders, has actually constantly been a source of support and fresh funding for the country. If you look at 2024 figures, the remittances was close to about $135 billion inward. So it has been a very, very strong support. Having said that, I think what the RBI came out on the 8th of June as a window of opportunity is expected to give a very sharp boost to reserves, provide stable long-term funding. When I say long-term, there is a bulk of the money which is expected to also be raised at 5-year window. But also you're opening up, I mean, there are other capital market measures also which have been taken alongside. But for the session today, we're going to focus largely on this FCNR bit. We've also seen that these funds, these monies from the NRIs tend to be a lot more stable and long term, and a lot of them often get renewed as well, right? And obviously, there is no sovereign borrowing pressure, so it's not putting a pressure on the ratings. And this will actually, in a big way, boost the buffers. I would say that this becomes your currency chest in a big way. Now, it is very important for us to understand what has actually been done and how does this mechanism really work. Because while banks, and we heard figures of $65 to $75 billion, these are very large funds to be mobilized over a very short period of time. We're talking about 3 months or so. But what is going to be done with these corpus of funds? It's just important to understand the mechanism. So what happens is this RBI swap facility, which has been done, is basically a sweetener being given to the banks to say that you can actually come to our window, swap your US dollar deposits to the INR. Now, important for all of us to realize that for any banking operations happening in India, bulk of the utilization of funds and transactions is going to be in rupees. Whereas if we are raising dollars, where's the sweetener element coming in place? So the story is very simple. We collect monies from our NRIs in the form of FCNR deposits, which could be, like we've discussed, 3 to 5 year tenors. These deposits, for this window specifically, the swap window of 3 months, have been exempted from CRR and SLR calculations. Every Thursday, the swap window opens up, and you have to place this deposit in bulk only on that day, consolidated at bank level. This entire dollar deposit is then in the swap window. You're able to actually convert your dollars into equivalent INR. And those INR, actually, the banks are able to utilize for their day-to-day operations. Now, important to realize here that why is this not possible on any regular time and only when the swap window is available? The answer is simple. The hedging cost to convert your to swap your dollars to INR is close to about 3% annually, which is a prohibitive cost for somebody to take an open-ended exposure, which is where whenever banks were raising funds through the traditional window, they would either use up for their ECB trades where they needed dollars, or they would necessarily convert that in the swap window and convert them to INR for their local operations. Now, this 3% absorption of cost for a period of 3 years or 5 years is the real sweetener that the RBI is giving to the banks. And this entire cost has been absorbed by them. Now, this is where the real opportunity window opens up. Because earlier, if the swap cost was not being absorbed, I could only be capped at lower rates because I was born. I mean, I as a bank was raising funds in dollars. I could only give you a certain capped rate of let's say 3.5%, 4% or thereabouts, which are the prevailing rates. But the moment the swap cost of 3% was absorbed, it gave the liberty to the banks to be able to compare their cost of funds versus the rupee borrowings. And so so you've realized that every bank has kind of raised their rates. Now, this is where the interesting part now begins. Because suddenly with the dollar rates going in FCNR deposit at around, we've seen the window circa of about 5.5 to 6.25%. The trades have suddenly become very diverse. So, maybe we can go to the next slide. It gives you a sense of how the leverage trades can also work. Now, two scenarios for you to consider. One is that you go for a plain vanilla trade, which is that let's say the deposit rate is 5.5%. For ease of calculations, we've used it over here at 5.5%. Let's say the simple rate is 5.5%. You place a plain vanilla deposit, it matures in 3 or 5 years. But the other option, which is also finding a lot of flavor and as part of the conversations, is to be able to use the balance sheet of banks which are flush with dollars to lever up your trades. Now, what it does is, hypothetically, you're actually creating leverage. You're creating a positive carry on each leverage leg. We'll take a simple example. Let's say somebody has a $100,000 of client equity, and the FCNR rate we assumed is 5.5%. If we take a leverage of 9 times, which means $900,000, the lending rate we assume is about 5%. Now, this is a function of the 5-year or 3-year, depending on what tenure you're doing, the 3-year or the 5-year so far. Right? That's a publicly listed rate plus the margin, the cost of servicing the loan for the bank. Once you factor in it, that the loan rate is expected to be somewhere around 5% for ease of calculations. Now, basically what you're doing is you're placing $100,000 of your money, $900,000 of leverage money. On the entire $1 million, you make 5.5%. On the leverage component, which is 9 times, you're actually incurring a cost of 5%. So in a way, with each leverage leg, you make 0.5%. And if you do the maths, this adds up to about whatever, 8.5%, 9%, 10%. And obviously these trades vary based on the cost of funds of 3-year to 5-year, and they vary because the cost of borrowing could be different. And similarly, depending on the leverage that is being offered, these returns will change. So a 5-year leveraged deposit with 19x leverage can give you returns of about 14%. Now, these calculations listed here are very illustrative in nature, because every week the loan pricing will be a function of at the time of the trade being booked, and that will vary for both the 3-year and the 5-year tenure. So some of the variations can happen, but typically one could expect mid-teens to low teens returns depending on the degree of leverage that they go for and the tenure that they sign up for. Now, put this in the context of what are the typical returns that you would expect. And we know that dollar deposit returns typically range 3 to 5% in general. Compared to that, on a relatively lower risk product, this accentuates your returns quite sharply. So we are thus talking about corpuses being very large and being raised on a very short interval. Now, it is also very important that none of this, I heard Vishalji speak earlier in the session that these are only discussions from an education perspective. Everybody's tax liabilities, etc., will change. They should be mindful of what are the risk factors involved. Now, while this is a relatively low risk product, this comes with a fairly high degree of illiquidity. Because there's a back-to-back swap that the banks do with the RBI, these funds cannot be redeemed without a cost of exit. Now, these cost of exits can vary bank to bank. Some banks will possibly deny it, maybe for the right reasons, but otherwise there could be penal clauses. So anybody considering this product should be very mindful that this money should be treated as a locked-in money. It is not available for early exit so easily, and the cost could be penal, right? If somebody were to decide to leave earlier, exit the product earlier. The other caveat to consider will always be based on individual tax circumstances or the market or the jurisdiction that you're investing from or borrowing from. There could be scenarios of withholding tax, etc. So you should consider it. There are and now in terms of how we're seeing in the market the modalities play out, there are banks which are doing this, both booking of the FCNR deposit in India plus the loan part, both on their balance sheet. Whereas there could be combinations of scenarios where the banks are booking FCNR in India on their balance sheet, but the loans are being sourced by partner banks. I mean, one caveat every investor should look at is what are the terms and conditions being done for it, etc., etc. But generally speaking, there is a very high traction for this in the market, and for a simple reason that this looks at a low to mid teens kind of returns on a dollar equivalent kind of product. In doing so, I think it's a big service to the nation for sure, because you're talking about reserves of $65-70 billion piling up for the next 5 years or so. And of course, you're going to tide out the period of high volatility. I think the last 2 years we've seen its highest amount of, actually 3-4 years, because we saw the Russian war also happening before this. So we've had a very high degree of market volatility in the last couple of years, reflected in how the equity markets have also played out. So all these are very connected scenarios. The good part is the inflationary pressures in India are still relatively under control. So if you look at it from that point of view, a return in dollars, which is low to mid teens, whereas the rupee inflation continues to be very, very benign, is a bigger arbitrage. All right. So yeah, I mean, if I look at an average depreciation of the currency, dollar to INR at around 2.5 to 3%, the return translates to a dollar return of 12%, translates to an equivalent of about 15% in the rupee terms, which is very difficult to beat often in equity markets as well. So with that, the only thing I would encourage people is look at this. It is an opportunity that you get once in a lifetime. This time it's been decadal because you saw this in 2013. The corpus is now doubled. But unfortunately, by the way, we handle both the domestic and the international business, and we've been hearing this is a very big crib from the resident Indians. Why aren't they given this kind of a carrot? So you all are lucky. You all are sailing in a very enviable boat right now, and happy to help wherever we can. But thank you so much, Vishalji. Back to you.
Yeah, thanks, Nikhil. I believe you wonderfully explained the leverage scenario, which is quite a difficult topic, I would say. 9x and 19x. So thanks for such a wonderful explanation. And now we'll move on to our third and final session. So we have Dr. Nilay Ranjan Singh. He is the CEO of State Bank of India, DIFC Dubai. So after going through basics of FCNR, the kind of features about FCNR, and the most important leverage, so we have now Mr. Singh, who will take through the practical aspects of FCNR. So some of the key things which we should need to look out. And before that, I'll introduce Mr. Singh as well. So he has extensive experience in international banking, treasury, risk management, corporate banking, trade finance, and leadership. He has a PhD in management and widely certified banking professional, recognized for his contribution to banking, financial, and financial innovation. He is a regular keynote speaker and thoughtful leader, has done many global discussions on emerging topics and banking finance. So over to you, Mr. Singh.
Yeah, thank you.
Before Nilay takes over, I must congratulate all the speakers that today is the first time due to this global webinar that we are in. There are over 1,600 members listening to Nilay, please. I guess
Thank you.
it deserves a round of applause to the speakers that we have been able to garner such an interest. So I must congratulate everybody over here. Over to you, Nilay.
Thank you, Sanjay. Thank you, Vishal. I think Nikhil, Ajit, and Rishi, because Rishi is a brother. Honestly, this is one thing, as I think what had been said now also, the residents are not getting this return. So when it is said, when our Prime Minister was talking about A square plus B square plus that 2AB. So that 2AB is extra, which is being given to the NRIs. So NRIs must feel lucky that again they are getting extra this 2AB, and 2 is a leverage part which is being given by the banks. So your income is more than what resident foreign currency account might have earned, and plus the leverage makes it even further better. So yes, it is very important that you have to be very practical. What is the amount which you are taking, wherein the way you are investing, and what could be the tax implication? Even if it is tax, what will be the liquidity? As has been explained. So it's a sort of fund which you forget for 3 years or 5 years, whatever you have taken. Because if you want to break in between for any reason, the fact is that you'll be paying from your own pocket. So that you have to be very mindful that whatever interest you'll be getting, it will be certainly less than the interest which you'll be paying on loan. So, in almost all the scenario, except 1 year, anyhow, you cannot break it. After 1 year also, if you want to break it, I think ultimately you'll be paying from your own pocket. So that you have to be very mindful. The second thing is that the tax implication, because the resident are not getting the same sort of return. So when you become resident, then again you have to calculate, okay, what will be your tax liability? And not only a resident, if you're moving from one country to another country, so tax implication might be very different in different countries. So ultimately you'll have to understand, or you have to reach out to the tax consultant, what would be the real implication of the tax, like withholding taxes there, and even if you become resident. For 2 years, you might get the benefit of RNOR, but that also has certain conditions, like whether 729 days within the the last 7 years, less than that, and then 9 out of 10 years you have to be the NRI. So the best important and the most important thing is that you have to consider that, okay, if you're investing for 3 years or 5 years, whether you will remain NRI. First thing. Second, you do not need liquidity. So whatever amount you can always park therein, which you do not require immediately, or at least for 3 or 5 years, you go for that. Third is that wherever, even if you are taking a loan, so even if it is against sort of your FD, FCNR, the credit bureau, because in UAE, if you're doing it, I think it will be repeated to the Etihad credit bureau. If it is in different country, it will be the same. Even in India also, it will be reported to civil, and there might be. So ultimately, when you are taking the loan, that also you have to be mindful, actually, what will be the reporting standard. Fourth thing, which is therein, if suppose you go to, you become resident, and you do not have any advantage of RNR or anything, you will be paying tax upon the whole amount. If you have got the leverage of, suppose, 9x only, you have brought in 1 million, you have got 9 million loan, you have deposited 10 million. So the interest upon 10 million will be taxed. So ultimately, even if you're at tax, a 10% tax bracket, it will not be very beneficial for you. One more scenario is that, okay, you do not go for leverage. So
I think there's some issue at Mr. Nilay's. Nikhil, Sanjay, can you hear Mr. Nilay? Okay. Okay, maybe I think in the interest of time, maybe I think Ajit, why don't I start the Q&A, And once Dr. Nilay joins back, we will hand it over back to him.
Yeah.
Okay.
Okay.
Yeah.
Sorry.
Okay, he's
Am I
back.
audible?
Yeah, please go ahead.
Yeah, unfortunately, because of the problem of technology.
No
So
worries,
the
no worries.
fact is that you
I
have to
also
be very
was having. Yeah, please go
Yes,
ahead.
sir. Yeah, you have to be very mindful actually, because the product has been explained very well by Ajit also. So the thing is that the most important aspect remains therein. Okay, what you have envisaged. Suppose you are getting 13%, 12%, whatever, mid-teen or high-teen. Will you be able to get the same thing for the time period wherein you have envisaged, 3 years, 5 years? Second, is there anything which you have to think of that, okay, like there will be tax implications, there will be changes, even FATCA, CRS, all will be applicable therein. Another factor which has come therein, if you want to invest a large sum, what is the source of income? What is the source of fund? What is the source of wealth? Like in UAE, there are like clients who had to be professional if they are getting it from DIFC. In Gift City also, major banks are doing through Gift City also. There might be certain requirement. I think in different countries also, I think Singapore, there might be some requirement. So when you are trying to go for any extra, that also you have to understand how to prove the source of fund and the source of wealth. Sometimes not only source of fund is required, sometimes the source of wealth is also required, whether you are having that much money and that can be invested there in India. AML KYC is one concern which has cropped in fact, one of the central banker was telling me that, okay, this is a very easy proposition, you are getting very good amount, but whether you have checked that, okay, the amount which is coming therein for this extra return, it is a legitimate amount. So that will be another concern, which is that the amount should be legitimate one. So it should be your money, it should be the proper money. So that also needs to be very importantly and very deliberately checked that, okay, your due diligence is proper. Both the side of the banker, but at the same time from the side of the investor also, that, okay, you are in a position to prove that, okay, all the documents which are required. In some cases, when the money has come, like the person is promoter or the company director, or he's getting some dividend, whether the other documents which are supporting that, because I have received one request wherein the funds, like their balance sheet is not stating what he has received. So in that scenario, we'll have to say no. So you have to keep all the documents also ready, that, okay, if you want to go for it, the documents should be therein to support the source of fund, even some cases wealth of fund, the wealth, your tax calculation. If you feel that, okay, in near future, no one wants, but then if you feel that, okay, in near future there'll be change in tax residency or in your residency status from a migration from one country to another country. Third is that what will happen in case of death. So this is one area which normally I do not say that, okay, this should be the case. Statute should not be the case in any even a single case, but you cannot obviate it. So in that scenario, what are the terms wherein you are going for the leverage for the banks? If it is a plain deposit, this is therein, nomination is therein. So that is a very important thing, especially for the people who are from UAE and other areas, because of the Sharia law, it is not so easy here. But you get the advantage in India. But in case of loan, what will the status? And whether bank will be able to carry or whether bank wants to carry. Especially in those cases, there are two scenarios. One, wherein both the sides, same bank is there. So in that scenario, bank can take decision that, okay, it can continue for a certain period, and then because the bank also has to run a loss if they are breaking in between. But if there are two banks, so it is coming from bank A and it is going to the bank B, whether bank B will be willing to wait for that period, that you have to consider, and that then you have to go for the documentation. What are the terms there in the document? Third thing, which is very important, which I have seen, is that when you are taking loan from one bank and depositing money there in another bank, there might be a time lag. There might be some restriction. There might be some imposition. Your money might come on day X, and you have to pay to the bank B on even X0, and you might cite in X+1. In that scenario, also you have to see whether you are in a position to make payment from your own pocket, or there should not be any delay. Because it is very easy to say that, okay, SBLC will be there and the bank will be remitting the money. But I have seen in international transactions that the bank said, okay, look, we have sent the money. Other bank is saying, no, in fact, we didn't receive the money. So two major banks in the world, and they are fighting who has delayed no one is going to accept. Both the banks are saying, in fact, it is not my fault. So in that scenario, it is the fault of the customer. Because ultimately, it's your credit history which will be impacted, not of the banks. So you have to see these practical things when you're going for the leverage. Leverage is a very important like lever by which you are maximizing your return. But at the same time, always see the small things which might create a risk. So that is what was from my side, which I wanted to say.
Thank you, Dr. Nilay. It was wonderful to hear you. You really decoded the practical aspects of the FCNR deposits. Now moving on to our last session, I believe Q&A, and this is going to be an interesting session, I believe, because in all across last 5-7 weeks, whenever I discuss with my friends and all, they have so many unique questions which come up, which I, as a chartered accountant or also as a corporate banker, sometimes I would say I need to scratch my head. Okay, oh, this is, I never thought about it. So we have few questions already from some of our participants who shared earlier. So I would start with slightly bit more basic, and then maybe those kind of slightly more difficult questions. So maybe for first question, since Dr. Nilay, you are here, so what would be your advice to first time in NRI investors?
So for the first time NRI, I'll say first thing is that you just check your status. You must like when you have left India, your account should also be converted, should not remain in the resident status because there is a penalty also for that. So you just get your account first converted to NRO, NRE, wherever and whichever way you want. And then when you are making investment, look, this is a very good opportunity. So whether it's a first time or it's a person who is staying there in for 10 years or 3 years or has made lots of investment, the only concern which I always say that if you're having some money, don't leave the liquidity. There has to be liquidity, even at least 30% liquidity has to be there. So whatever amount after this liquidity, keeping this liquidity, if you can spare, you can always invest in this because this is one of the best return. And I think in some cases, in our case, it is less minimum amount is 100,000. In some cases, there might be 50,000 also. So whatever you feel that, okay, you're having extra money, which you can spare for 3 to 5 years, go for it. But at the same time, keep some liquidity because you'll not be able to get any money back. You can get it. Theoretically, you can get it. But theoretically, if you get it, ultimately, you'll be paying from your own pocket. So instead of getting something, you'll be losing something. So keep some liquidity. Get your status converted in India, and if you are having enough, go for this because this is a return which is in this volatile market much better. Whether it's a gold or real estate, you see compared to that, it is giving a very good return with almost no risk except few practical risks.
Yeah. Okay. Thanks, Dr. Nilay. So I think Ajit, the next question I will ask you to help with it. While you had briefly explained and covered it in your slides, so there are a few questions in terms of how about NRIs who want to plan or who have plans to return to India back, because there's uncertain environments and all. So, and another related question is that what happens if supposedly if I relocate to India? So Ajit, maybe if you could just take that question.
Yeah. Good question, Vishal. So it's when NRI decides come back to India for good, I would say a returning NRI. What happens basically to his accounts? FCNR deposit can continue till maturity. Okay, till maturity, he need not to liquidate. However, the tax liability starts on interest earned on such FCNR deposit the moment he comes back to in India. Okay, so from that day, whatever interest he has earned, for example, he has booked the FD for 5 years, he has completed 3 years, he's coming after 3 years, so residual tenor is 2 years. So on residual 2-year tenor, he has to pay the tax on interest. There could be a scenario. His status may be a resident, but not ordinary resident. Under that scenario, he will get the tax exemption for 2 years. So as, Nilay sir also said, what is a resident but not resident status? Out of last 10 years, he should have been 9-year NRI. or during last 7 years, he should not have been in India for 730 days. It is very important. While coming back to India, he must consult his tax consultant in India, his chartered accountant in India, and accordingly he should plan. NRE rupee deposit, immediately it get redesignated as a resident rupee deposit, and interest on such redesignated deposit is taxable. At the time of conversion NRE to rupee resident, he has an option to convert that proceeds from NRE FD into foreign currency and book the RFC fixed deposit, RFC deposit. Interest on RFC deposit is a tax-free for 2 years. This is the things. But if you choose NRE rupee deposit to convert into domestic resident rupee deposit, from date of the conversion onwards, whatever he earn interest will be taxable, even if his status is resident but not ordinary. Yeah.
Okay. Thanks, Mr. Ajit. So since you are here online, maybe I will also take a related question. While this was in terms of returning NRIs, what happens like in case of an unfortunate situation wherein the depositor's demise? So people would be basically a bit jittery that, okay, you're taking a leverage facility and you have family to support. So what happens in terms of if there's a death of the depositor?
So basically, a leveraging bank, they will basically be decision maker. India Bank will not take basically any decision because the right on such deposit will be favoring a leveraging bank. So whatever, because leveraging bank has already made the agreement with the account holder covering all these scenarios. And while booking the deposit under leverage arrangement, Indian Bank will confirm to the leveraging banks, say, by marking the lien on deposit, they have issued the SBLC, and they will have basically, first they will listen to leveraging bank. Yeah, that's the stance, sir.
Okay. And in terms of, I think, if there's no leverage, if it's a normal FCNR deposit, and say for 3 years or 5 years, I believe if there's a death of depositor, they would have will the premature liquidity penalty will still be applicable because there's a fixed minimum 1 year, and after that there's a penalty around it, or there are some waivers for this kind of scenarios?
So Reserve Bank of India always think point of the account holder, and it's legal here. In case of the death claim, there is no penalty on such premature liquidation of deposit. Bank gives the option to the legal heir. Till maturity, they can continue the deposit, and on maturity, they can claim. Or if they want to have the deposit prematurely, bank is free to pay the interest without charging any penalty.
Great. I think that's quite helpful, I believe. And so effectively, I think in leverage, maybe RBI may not have direct
So,
control.
Vishalji, maybe I can also come in
Nikhil.
here on
Please.
this point. So I think and this is a very critical point, and he mentioned that the right, of course, will be for the leveraging bank, etc. Very true. So in our case, for instance, I mean, just as an example, now this is a very unfortunate event. So we give the right to the investor, I mean, the legal heir, to either continue the deposit, which of course is there, but also on the loan, we are saying that, I mean, there will be no penalty, etc. So the options are there. So either you continue with the loan along with the deposit, or you sort of liquidate that with, no penal clauses, so to say, because this is an unfortunate event. But it's also true that these terms can vary based on who the leveraging bank, etc. is. But this is a very, very important point of concern to me.
Okay. Thanks, Nikhil. Since Nikhil, you are here, so maybe I just take the next question with you. So the next one is, I would say, is kind of a concern for, or maybe a risk for everyone who's looking at it, which is like a very simple one. That is leverage FCNR suitable for everyone, or is it only for few high net worth individuals?
So definitely not suitable for everyone. because like I said earlier, look at your jurisdiction and also the tax implications from a withholding tax perspective. So you have to look at your borrowing jurisdiction and you have to look at your local regulations. That apart, leverage, while in this case it's a fully hedged product, so there is no mark-to-market volatility expected. But there, I mean, from a banker's perspective, the risk remains that one of the biggest risk, and of course, I know Nilay clarified that there's no capital convertibility, etc., because it's a fully repatriable money. The worst case scenario is that if the deposit matures, but there are capital controls applicable, there is still a loan which is outstanding from an overseas market, right? And that remains as a liability. So it is still a big factor that people who are comfortable with the way leverage works, knowledge and experience filters need to be applied. As long as you fully understand the entire spectrum of it, then it's a fair trade. But fair to say that it's not relevant for everybody. They should totally understand the implications of it end to end.
Sure. Thanks, Nikhil. And maybe there are a few questions around in terms of the number of times of leverage or a minimum investment amount for a leverage. So as per my understanding, it's a bank's prerogative and bank's internal policies, which basically allows that, okay, it's minimum 1 million or a minimum 5 million. I believe RBI doesn't have any strict guidelines in terms of how much minimum thresholds which we should have. So that's my understanding. Maybe Nikhil, if you have anything to add upon in terms of the minimum amount for leveraging.
Yeah, that's a commercial decision. So, I mean, like Nilay also earlier said, they probably have $100,000. So, I would suggest they should speak to your respective bankers and get that clarity. But whatever pricing, etc., are all commercial decisions. How much times leverage is a function of suitability for each client. Every bank will have its own process to decide how much leverage they want to give to a customer based on their net worth outside of the overall net worth assessment, etc. So there are these various parameters which is part of the credit underwriting norms.
Yeah, so basically people should not go over leverage. They should look at their repayment capabilities as well, because the next question is slightly tricky. Okay, I would say, and since it's leverage facility, maybe Nikhil and others can also add in. It talks about that if the deposit bank, whichever bank they place the deposit, if something goes wrong, unfortunate goes happen with it, it's become bankrupt or there's some licensing issues, regulatory prohibition on that bank, then what happens to the leverage facility and what are the risks around it?
So my understanding on this is very clear. The two trades are separate. One is a deposit trade into India. The other one's a leverage facility from offshore. The two are just coming together to make the product viable for you. If something goes wrong with the deposit, you will be regulated by the degree of insurance that exists for deposits in India. And the loan continues to remain outstanding in that case. So both are two separate legs. Your liability on the loan will exist to fulfill. So you obviously have to be cautious about it in terms of the choice and credibility of the bank. But yeah, I mean, that credit risk element always remains if your issuer itself goes bust. In this case, the bank you place the deposit with.
Okay.
I'll add to Nikhil. So there
Yes.
is one thing, but in some cases, right of set off, if it is the same bank and if it is a sort of branch network, so that way there will be right of set off. So that benefit will be therein. So the extra portion which is therein, that will be exposed. But if there are two banks, as Nikhil said, is very correct that these are two transactions. You might be in trouble. So in that scenario, you have to see, because this is a credit risk and then sort of regulatory risk also. But if it is the same bank, in some cases, it might be the right of set off will be there. So you'll be exposed to the rest of the person. But still, rest of the person you might not be able to get.
Dr. Nilay, very
something
valid point. Maybe, yeah, just for some of the benefit of our participants, maybe just like to spend some more time on this. So supposedly if there's an ex bank which is giving a loan from GIFT City, okay, and the deposit is being placed ex bank maybe in Delhi branch, okay. So both are Indian scheduled bank and regulated by RBI, while GIFT City is an offshore banking unit. So the loan is from the GIFT City branch and the deposit is placed in the Indian branch. Worst case scenario, while our institutes in India have performed quite well, and whenever there have been unfortunate situation, our Reserve Bank of India have come and supported. But just for discussion purpose and to clear the air around it, if the branch in India becomes bankrupt or there's some restrictions around it, so then how does it work if it's in this structure?
Look, with the disclaimer, because in the fraud and many
Yeah.
other cases, things will be quite different. But if it's a just plain transaction wherein the bank fails, look, if a bank fails, it will fail at both the places, because basically, if these are branches, even if they're in various geography, the thing is that they might be regulated in different geography, so that restriction will be there, and that capital might be saved. But ultimately, if bank fails, like there won't be something which they'll be able to pay. But yes, that insurance will come into play first, but that will be in INR. The second thing is that set off will be there, because if it is the two branches of the same bank, so ultimately bank has the right. So that way, if it is not paying, so then set off will also come into play. But despite all these things, there are so many disclaimers, because then capital in different countries, that will be applicable to those like the branches there in that country. If it is like in Frankfurt, there's a capital which is need to be placed therein only. The second thing is if it is a fraud or anything. So in that scenario, even the before that, if there's ill-gotten money, that might be stopped. So in that scenario, even the bank will not be having any safeguards. So straightway, the full money will be frozen or might be frozen. So legal and few things will always be there, and that is like plain risk does not appear, but then there are so many things which you have to take care of if you're doing it. Even if the tax, I had always said, okay, if you go there, you'll have to pay tax upon the whole amount if you are resident. RNR, you might have some benefit, but the moment you become a resident, you have got the leverage, but you'll be paying the tax upon the whole amount, and interest upon the loan will not be deducted. So you'll not have the right of, like I'll say, adjustment.
Sure. No, thanks. I think this is a very pertinent point. So while, as I mentioned the first slide, that this is our only a knowledge sharing session, and it's not something that the participants should decide their investment decision based on the discussion which is happening today. But generally, if I understand this well, if you are doing the leverage and deposit with the same bank, it's easier, and I would say more closed, rather than using SBLC structures or some other creative structure, I would say, wherein you have different counterparty, maybe an X bank in India and a Y or Z bank overseas. So then the risk becomes higher. But anyways, those interests are also higher on those types. So I would say that nothing is good or bad. So if your returns are higher, your risk are slightly higher. So that's how it is. Again, the second question is also on withholding tax. So while I understand that you are all bankers and not tax expert, but if you could just give us some light on it, maybe you or Ajit, whoever can want to pick this up. So there are some discussion mostly for Singapore depositors, I would say, that there is a withholding tax angle to it, like maybe the kind of interest which is paid to, say, GIFT City branch, which is providing the loan. Is there a withholding tax angle which comes into play? So if you could give some light to that, Dr. Nilay or Dr.
Vishal, I understand interest, dividend, capital gain on, okay, even if in Singapore or outside Singapore, is it tax free? Correct.
Okay.
So
Yes.
whatever interest on, there will not be any taxed in Singapore as a global income. Understood?
Okay.
Yeah.
Yeah. So that's fine, Ajit. But there's some thought around that when you pay interest on the loan which you are borrowing, will there be an
You're
withholding
talking
tax?
about loan expenses?
Yeah. So when I do a leverage and if I'm paying interest to the loan, my understanding is that anyway the money is not going out of Singapore. You are basically placing a deposit offshore from a Singapore perspective, and the loan is also offshore. Both are netting off. There is no actual outflow of interest from Singapore. But some people have a theory that, okay, you're paying interest to an offshore entity, offshore lender, I would say, non-resident lender for Singapore. So is there a withholding tax angle for that or not?
As far as India concerned, okay, Indian tax law or Indian regime, we don't consider any, if the money is taken on the loan basis and you earn the interest, that expenses are not considered loan expenses.
Yeah.
I'm sure, I mean, Singapore also law will be in the same line.
Yeah.
Yeah.
No, so
Yeah,
maybe
this is
I
from
can come in
yeah.
here,
Yeah,
Vishal.
Nikhil, please.
Vishal, yeah.
Vishalji, so we are not advising any clients on taxation, but one of the things I'd said is tax for certain jurisdictions, including Singapore, Thailand, etc., has to be kept in mind by the person. There is a possibility of what you said holding true, that if the borrowing is from any non-Singapore location, the interest that is paid out is subject to taxation. So if the borrowing is from gift, etc., but I think that then becomes the call of the investor, or one has to take a guidance from the IRAS directly. But we are definitely telling all the investors that they should take professional advice on this, including on the withholding tax on the interest that they pay. So
Sure.
it's a fair call out that you did.
Okay.
I'll also go with Nikhil because unfortunately this might be something if happens later on. So what Ajit has said also has a point, but the fact is that if anything goes wrong, ultimately the best part is that, okay, disclaimer, you just check it and then only invest it.
Sure.
Nilay, that true, very true, because the tax consultant plays very important role, who has a knowledge of the international taxation as well as the local taxation. Yeah.
Okay. So something which is related to the previous question, that if the Indian banks go default and all, and I think Dr. Nilay had previously picked this point in terms of capital control. So while we believe that our country is very strong and we don't foresee any of this kind of scenario, but given as an individual investor and who would be putting a kind of sizable amount. So as I think Nikhil pointed out that this is once in a lifetime opportunity for NRIs. And there are few of my resident funds that say that, okay, you guys are getting kind of a jackpot. So if people are putting some sizable amount, and so they have concern that, okay, if there's a capital control in India and the depositors are not allowed to take the money back to out of the country as after 3 years or 4 years or 5 years. So there are two scenarios. One is that they have taken leverage, one they have not taken a leverage. So if you could just guide on both the scenarios, maybe first the non-leverage one, which is easier, and maybe the leverage one subsequently.
No, I'll say one thing. Look, whether it's a leverage or non-leverage, ultimately the money which you'll be getting back, unless it is a interest payment. So you have brought in 1, I have given you 9, it is 10. But ultimately only 1 has to go out, 1 plus interest. If you have not taken leverage, in that scenario also only 1 has to go out. The only thing, the interest amount will be different. So that way it should not be the concern if it is the same bank sort of thing. The second thing is that look, it will not happen because in 2013 also we did it and we paid it. 23 also, it's not like 26 also, it's not that India is not having the forex reserve. The thing is that time what I wanted to say, I have said that, I think Rishi knows it, that this is the money which country can get it without any string attached. So if there is investment in certain area, even if I do not want, because the investors are coming because they want to do it, this investment is something which is coming to India, the way government wants it can use it. So that way it is very important, and no country can afford to hit their investor base, because these NRIs have not invested once, 3 times, 4 times theoretically, and 4 different times. Like it was, I think, yes, 2013, even 98, earlier also. So government knows it. Like in Hindi, when we say that sone ki kanda dene wali murgi, so he cannot afford to say NRI, look, you do not need to invest in India, because that will be, sorry, thank you, this is the last investment from NRIs. So that will not happen practically also. And other also, it is the banks which are taking the exposure. So ultimately, you're not giving to the government of India, you are giving to the banks. Banks are having international presence. So if there is a capital control, you'll be in that scenario, will the whole India growth story will be finished. And that way also, I do not feel that a 5 years is something wherein we'll be going down that path. So despite having all the trouble, because we survived all the wars also, even to certain extent tariff also, and this war also, we have survived till now. So we'll be able to survive. So that should not be a concern straight away.
Dr. Nilay, one thing I want to quote, there was a deposit, old NRIs may be remembering, NR deposit, non-resident, non-repatriable. Okay, so in that scheme, the money has to book from the outside India, money has to come. And the interest rate was higher than the NRE rupee deposit. When RBI government decided to discontinue this scheme, they allowed on maturity to repatriate money or credit to NRE account. So Indian government, I mean, at the time of booking deposit, they are deciding to repatriable. I'm sure such scenario will not come in India.
Okay. So there's a follow-up query in terms of the questions which we raised earlier, in terms of a very unlikely scenario of a bank going default. So is there a way to leverage it? I think there would be exotic products available in the market to take a credit swap on those banks, but then the return, I believe, would be eaten up. So if you have any thoughts on that in case you do have leverage FCNR and you want to take additional protection to protect against the depositing bank.
Normally, the choice
Look,
would be to go with a safer bank. I think.
Yeah, Nikhil is correct.
Yeah, I agree with the Nikhil. That's why while booking the deposit, investor will see that. Even
No, Ajit is right. Look, why do you want to complicate it? Look, we always love the structured products because that seems that okay, we are doing something very great. But the fact is that you are getting better return at this with almost no risk. If you want to take the risk, there is always available equity. So because if banks goes down, honestly, I think these are the larger banks, HSBC, HDFC, ICAI, even public sector banks, SBI. So if these are going down, I don't think that even serious, because suppose I'm giving this simple example. If it is SBI, what will remain there in India? Nothing. So ultimately, you can take it because if you want to have something, but in practical sense, I do not feel that this is required anyhow.
Sure. I think mostly I've tried to cover most of the burning questions which I could see in the group. Give me some 10-15 seconds to see if there's something new which has come up. Give me 10 seconds, sir, because this is the question answer round was supposed to be the most sought after thing. So allow me some time to see if there are anything which I would have missed out. Okay, so this scheme is being governed by RBI. So, and in terms of in case of any new political changes, do you think that there can be an impact, or this is something which has been crystallized and fixed for say next 3 years, 4 years, 5 years?
Theoretically, RBI is independent. So even if the government changes, it won't change anything. 13 and 14, government was changed. So there won't be any change.
Sure.
And plus, it has two parts. Leverage is coming from the banks. So RBI is having only deposit. The interest part is being given by the banks. Leverage is being given by the banks. So there are two parts. So politically, there won't be any change.
Okay. So I think I only have one last question, which is there. In terms of RBI is raising these funds for the next 3, 4, 5 years. So what would be the plan of RBI to repatriate these funds? So maybe Ajit, if you would like to take this, because all these FDs will mature in one single shot, maybe for most of it will be 3 years. So what would be plan of RBI to repatriate these funds out there?
So basically, bank is swapping the money with RBI. Okay, and every week we are giving the 3-year, 4-year, 5 years swapping the money. And after 3 years, let's say we are taken, as a bank, I will go whatever the rupee funds RBI has given to me, and I will take my dollar back, and I will repatriate. Basically, I don't see any problem because that is the way why the scheme has came up, where the RBI is giving the incentive to the banks waiver of CRR, SLR, and RBI is completely hedging the money. So money whenever we want, I mean now during 2013, even if the prematurely anybody wanted to withdraw, we have to go to RBI. RBI used to calculate what is the loss, whatever the calculation that was borne by the investors. This time RBI said RBI bank has to calculate accordingly and repay as per their terms and conditions. Okay, Nikhil, you want to add anything?
No, I think, can you hear me?
Yeah, we can hear you. We can hear you.
Yeah, no, I think I completely agree with what Ajit said. I see zero risk. And anyway, the country, the reserves condition is already very, very robust. Plus, we expect actually the FPI, FDI flows to also resume. So this is zero issue. This is a fully hedged trade from that standpoint, as long as it fits the client suitability criteria. And we discussed about, by the way, borrowings, etc. There is no extreme scare or anything about it. It's just that as long as you look after, you don't chase the last dollar return, but you go after, I mean, quality trade and understand the risks, etc. around it. It is a godsend for the overseas community. So I wouldn't dwell too much about it. I think the only biggest risk we feel to highlight is about capital controls. If they come and the money is not allowed to be repatriated, probability of that happening is extremely low. Beyond that, the trade will go through. It is not going to be impacted by political changes, etc. Like Nilay ji explained, we've seen that happen in 2013-14. So those are not real risks to mitigate in a big way.
Thanks, Nikhil. I really
Vishal,
Yeah.
one of the questions which generally being asked is also that is there a cap? Will this suppose if we reach a certain target of the collection from the government, is this going to stop? So I don't know who will take this question. Possibly Ajit, you can.
Yeah, no, this question is asked on several forums also, which I attended. But looking at the RBI approach, I don't think till 30th September this scheme will continue. I was about to say customer need not to rush for prematurely liquidating their fixed deposit to get its higher rates, because this scheme allows the maturity proceeds of existing FCNR deposit to invest. So investor should see this calculation, because premature break is not allowed to break and take in this scheme, but on maturity proceed you can take the money. So I don't see, looking at the RBI's meeting, because ECB scheme, external commercial borrowing, that is also going to continue till 31st December. And this FCNRB will be 30th September. So even if the government gets the more money, I don't see the FCN, it will be prior to 30th September.
And a follow-up question, I guess possibly Nilay or Nikhil, if you can take it, is that the leveraging that we talk about, means when we are talking about leveraging offshore to invest back in India, is there any limitation with respect to the leveraging that we are talking about, or means there are various other forms of that we keep talking in terms of the SBLCs and all?
Yeah, I'll take this because ultimately, whether it's for HSBC, for SB, or for any bank, look, you have to arrange fund. Customer is bringing only one, bank has to bring 9. So every bank will be having certain capability and certain amount which they have kept in mind. So honestly, if it reaches that level, after that it will be difficult to accommodate. But certainly every bank might have kept some amount, okay, wherein they will go for leverage. SBLC route also is good, but then there's a second risk wherein many customers do not want to go for SBLC, but since they do not have any choice, they go for SBLC. That is not the first choice. The second thing is that even SBLC also ultimately some bank has to fund. So it also depends upon the appetite of a bank. A bank might be having, like I'll say, tie up with 3-4 banks there in India. So they also have to see, suppose they want to do 1 billion. and there are 4 banks, average comes to 50 million only. Or suppose in one bank they might say, okay, 500 million, second bank 200 million. So ultimately it depends upon the capability and capacity of the bank, and ultimately this scheme depends upon the bank if you want to have that much deposit. If it is small deposit, it is okay, but if you want to have 40 billion, 50 billion, or even 60, 70 billion, it is the role of the bank up to what extent they can do leverage, up to what extent they can accommodate the customers, up to what amount they'll go for it.
Okay, thanks, Dr. Nilay. So there's one question which has come up and which looks slightly interesting. So maybe I'll just take that. So as Ajit, I believe, mentioned that when you do go back to India, the returning NRI, so there are restrictions in terms of your residence status, and then the taxability kicks in. So if you have taken a leverage deposit and in a situation wherein the interest becomes taxable, interest earned on the deposit becomes taxable. So what about the interest which is being paid on the loan? Would it be allowed to be adjusted, or both are different legs? The
No,
interest,
no, no, straight way it will not be adjusted.
No. Now, as
In the
I
case of
said,
individual, no adjustment.
correct. As I said, India does not give the deduction of any borrowed interest expenses. So whatever interest is earned will be taxable in India. So therefore, accordingly, it is very important to plan. Especially the money is invested in leverage, he should prefer to come after 5 years. Dr. Nilay, agree? He should actually.
that is not in hands
that
of
is what I'm telling
NRI.
since start.
So you can
That is
take,
what
he
I'm
can
saying.
take a 3-year leverage. That also you
Yeah.
can think about that lower leverage.
Yeah, because see,
Vishal, sorry. In fact, I'll have to leave for another meeting.
Sure,
So
sure.
I'll be leaving.
Yeah,
Thanks a lot. Thanks for
Dr.
giving me the
Nilay. It was
opportunity.
wonderful having here. I think we are almost close to our question answer session as well. I would just have one
Thank you.
small question we have here. Maybe Dr. Nilay, you can take a leave. We'll just ask Ajit here. So
Yes,
Ajit, most of the
Vishal, just before Dr. Nilay leaves, between the 3 speakers, if you are okay, we would be sharing your coordinates with the speakers, because quite a lot of coordinates requirements and your details requirements have come on from the delegates. So if
You
you're
can do so.
okay,
Yeah, I'm
we
okay.
can share your email IDs with them. Is that okay with you?
Yeah, you can do so.
Yeah.
Fantastic.
Yes.
Thanks a lot.
Dr. Nilay.
Thanks. Have a nice day. Thank you.
So Dr. Ajit, this is sorry, Dr. Not Dr. Ajit. I believe we will close this session by this last question. So while most of the common is US dollar deposit, while you can see that the attendees here are mostly from Asia and GCC as well, Dubai, Kuwait. While there are few people who have also joined from US, it's early morning for them. So, but we have, as NRI, we have funds in our local currency in Sing dollars and GBP or Euro for some other. Okay, so what's your advice to them? Like, we should look at US dollar deposit, or you should convert, or you should do it in the local currency of your earning. What would be or you split it 50-50? How does it work? Because US dollar deposit higher rate of interest.
Correct. See, some investor has to calculate actually, because when you are converting your local currency to dollar, there will be conversion expenses. Okay, so that he has to keep it in mind, and accordingly has to work out. See, locally, if he's getting good returns as a conservative side, in Singapore dollar, he's getting a good rate of interest in India. He must be thinking about that. But one is cross currency, he has to work out and see what maturity he will get it. That is really important. Obviously, conversion is cost is involved expenses.
Okay, maybe with some disclaimers. What's your view on US dollar? Because how do you see US dollar against Sing dollar?
This entire RBI has come up with the streamline, basically strengthen our rupee. Okay, that's the entire thing. So I'm sure rupee will do well. My guts feeling is after October, rate of FCNR interest rates in India will come down, which has happened in 2013.
Okay.
So by that time, country will have the sufficient foreign currency deposits.
And how about dollar performance against other foreign currency, maybe Sing dollar, GBP, Euro?
So no, I would reserve my comment on that.
Okay. Maybe Nikhil, you would like to add up that? That's the last question which I have for the day. Sorry for so many questions over the last 45 minutes. Okay, I think Nikhil is on mute. I think he had to take a
Nikhil?
flight.
Yeah.
Sorry, what was the question? I missed that.
So what's your view on US dollar against other foreign currency like Sing dollar, GBP, Euro? Because see, some of the, for us, like I'm based out of Singapore. So for me, Sing dollar is my local currency. So if I need to do deposit in US dollar, I will convert. And
Yeah.
see, after tomorrow, three years later, if US dollar depreciate, then that 14% will look at 5% or 4%. So what's your view on those
So,
foreign
I
currency?
mean, this is a very broad-based topic by itself, but I can just tell you that this is a function of the dollar index. Sorry, I'm in a flight actually.
Yeah.
So dollar index you have to look at, which is currently 101, which is dollar against a basket of currencies. So we are seeing fairly good intrinsic strength of the dollar, and this is largely backed by a lot of equity flows which are headed towards the US thanks to the whole AI trade and tech-led innovation which is happening there. So, I mean, you have to take a very country-specific view, but dollar will continue to be fairly bullish. On rupee specifically, because it will vary, right? Rupee has fallen sharply. So there is a view that it could go to 92, 93, what Ajit also sort of hinted at. But for various other markets, it will be very different versus their intrinsic strength against the dollar. I mean, for instance, we are not highly constructive on Europe and UK. So there, you could see those currencies relatively weakened. But whether it's how is it going to be with Singapore, etc. So fairly complex relation.
Yeah.
But we are not expecting dollar index to come down in a big way, which means that it will still remain fairly strongish as a currency, the dollar part.
Okay. Great. Yeah. Thanks a lot. With this, we will end our Q&A. Nikhil, safe flight for you. And thank you very much. So I will pass on the baton to Nikhil Jain, who is our secretary for Singapore chapter, for vote of thanks. So over to you, Nikhil.
Thank you, Vishal. This has been a fantastic session. Of course, a lot of questions are there and a lot of questions have been answered. But as we come close to the close of this insightful webinar, it is my privilege to propose this vote of thanks. At the outset, I would like to thank our seniors, CA Prasanna Kumar D, Honorable President of ICAI, and CA Mangesh Kinare, Honorable Vice President of ICAI, for their continued encouragement and unwavering support towards all these global member initiatives and the community. My sincere thanks to International Affairs Committee of ICAI for partnering with us in bringing together this valuable knowledge session, and to the leadership of both ICAI Singapore Chapter under the guidance of CA Sanjay Gatani and ICAI Dubai Chapter led by CA Rishi Chawla for strengthening collaborations across overseas chapters. A special thanks to CA Kushal Jaju, Vice Chairman of ICAI Singapore Chapter, for initially seeding this idea to take the webinar to a global scale. A special word of appreciation to our distinguished speakers. A lot of paradigms got discussed. Mr. Ajit Pandit, he helped us understand the strong foundation by simplifying the concepts of FCNR deposits, their regulatory framework, eligibility, practical benefits for NRIs. Mr. Nikhil, thanks for sharing your valuable insights into the international banking, the leverage part, and as well as understanding how the global Indians can have various aspects to manage better their optimization of international funds and some of these things. Dr. Nilay, thank you for providing this strategic perspective on international banking, treasury, wealth management, and also understanding some of the basic nuances, how NRIs can make more informed decisions. Again, my heartfelt thanks to C. Vishal Tibrewala. Thank you for taking the questions and some of these intriguing ones as well, for seemingly seamlessly anchoring today's session. Behind every successful event, there is a dedicated team. And I would like to sincerely thank our volunteers, the organizing committee, and every team member who has been behind the scene to make this today's webinar possible. Finally, a biggest thanks to all the participants, your enthusiastic participation, thoughtful questions, and the continued commitment to the profession. This made this session truly meaningful. Thank you once again. And we look forward to welcoming you at many other ICAI Singapore Chapter initiatives. Have a wonderful day ahead. Thank you, everyone.
Yeah. Thanks, Nikhil, for the wonderful vote of thanks. And my personal thanks to all the speakers, all the chairperson of the chapters which are involved in the webinar. And apologies, my video was not on in the initial part of the webinar. There was some technical issue, and which our volunteer CS Anjana helped me to take it over. So special thanks for her to be the backbone of this webinar. While we tried our best to clear some of the questions around this topic, which is, I would say, very relevant for all the NRIs, and what Nikhil said, that this is one of a lifetime opportunity. I don't know whether lifetime or not, but yeah, it's looked like a kind of a jackpot. And many of my resident funds have called me that, okay, you NRIs are getting kind of a bonanza. So I believe we should take advantage of that. But yeah, at the same point, we should do a proper due diligence, especially around taxation, your liquidity, the kind of investment framework you have, or you're looking some funds in terms of education and all. So that's something which is there. And I think Sanjay wants to speak something. So
Vishal, I'm pretty sure when we talk money, the 1,700 participants who have participated in this, the overseas, I guess we should be able to clock in more than $1 billion of investments for the banks, for HDFC or for SBI or for HSBC.
Unfortunately,
that we already said it's a knowledge-based
Sanjay, this is for a country. Country need this.
Sir, you are absolutely right. I mean, so what we wanted to say is, as CAs, as this platform, since we had 3 learned members, we have such a beautiful webinar today, and we should be able to garner in more than $1 billion for the country through this webinar. And we'll be proud to if we can clock those numbers.
Absolutely. I got stuck into a meeting, so I had to join a little late. Sorry about that. But I was getting also a few messages from friends around that, oh, this webinar is going good, because I had also circulated in my circle and a lot of people has joined. So I'm sure Sanjay ji and Vishal, Nikhil, what you have mentioned, and all the speakers, this would have been definitely an amazing knowledge sharing for all the participants who have joined the webinar today. So yeah, thank you everyone. Thank you everyone for being part of this, speakers, organizing team, as well as the participants to join with us today.
Maybe Ajit, Nikhil, and Dr. Nilay is on there. Maybe you can have a dedicated team who can handle ICAI Singapore and other ICAI chapters queries, so that we can know that it's more than $1 billion for sure.
Vishal, one quick check. Do we have a photo with all the speakers? Do we have a group photo?
I'm not sure, because initially my web photo camera video was not working.
Yeah, we have the photos.
But maybe we can take
otherwise
one more.
we'll
not sure if Nikhil and I think Dr. Nilay had to drop out, but Nikhil is in the flight. So
thank you everybody.
All right, thank you everyone. Yeah,
thank you.
Thank you everyone.
Thanks everyone. Thanks a lot.
Thank you. Take care. Bye bye.